At 2:47 in the morning, somewhere inside a data center, a server is burning electricity so a chatbot can help someone rewrite an email they were too lazy to write themselves. And somehow, Wall Street looked at this and said, yes, this is worth trillions of dollars. That is the strange reality of the AI boom. A technology that might genuinely change the world has somehow also become the most crowded trade on Earth. Investors are buying chip companies, cloud companies, software companies, power companies, cooling companies, data center REITs, AI startups, and basically any company that can put the letters A and I close enough together on an earnings call without laughing. And that brings us to the question of today's video. How big is the AI bubble really? Because the answer is not as simple as AI is fake or AI will change everything. Both of those can be lazy answers. The uncomfortable part is this: AI can be real, useful, transformative, and still be a bubble. That is the part people hate admitting. Because when most people hear the word bubble, they think it means the technology is fake, but history says something very different. Railroads were real, electricity was real, the internet was real, smartphones were real. And yet, investors still manage to turn real technologies into financial disasters by paying prices that required the future to arrive perfectly, instantly, and with no delays, which is basically Wall Street's favorite bedtime story. So let's start with the story everyone wants to believe. The AI story sounds beautiful. Companies spend money on AI. AI makes workers more productive. Productivity rises, profits rise. The economy grows faster. Everyone gets richer. The machines do the boring work. Humans become more creative. And somewhere, a consultant charges $900 an hour to explain this using a triangle diagram. And to be fair, parts of the story are probably true. AI is already useful for coding, customer service, writing, research, design, translation, and automation. Companies are experimenting with it because they would be insane not to. If a tool can help one worker do the job of 1.5 workers, every CFO in the world is going to stare at that tool like it just walked into the room holding free cash flow. But this is where the story starts getting weird. Because the stock market is not just pricing in AI will be useful. It is pricing in AI will be useful fast enough to justify one of the largest capital spending booms in modern history. And those are not the same sentence. At one point, NVIDIA's market value crossed the multi-trillion-dollar level. The biggest tech companies have been committing tens of billions of dollars each year toward AI infrastructure. High-end AI chips can cost tens of thousands of dollars each. Data centers can cost billions to build. GPUs may need to be replaced after just a few years. And electricity demand from data centers is no longer some tiny side issue. It is becoming part of the investment case itself. This is not a software update. This is a physical industrial build-out. AI needs chips. Chips need factories. Factories need equipment. Data centers need land. Land needs power. Power needs grids. Grids need permits. Permits need politicians to stop turning infrastructure into a hostage situation. And every step in that chain costs real money. That is why the AI boom is so different from a normal software hype cycle. A normal software company can sell a product, scale with high margins, and print cash if the product works. But the AI boom is demanding a mountain of upfront spending before anyone can fully prove how much money the end customer will actually make from it. In other words, the AI economy is currently building the restaurant before it knows how many people will pay for dinner. And that brings us to the real mechanism behind the bubble. It works like this. Step 1, investors believe AI will be enormous. Step 2, big tech companies spend aggressively on chips and data centers because they cannot afford to fall behind. Step 3, chip companies report massive revenue growth because everyone is buying the shovels for the gold rush. Step 4, those earnings push chip stocks higher, which pushes indexes higher, which makes investors even more confident that AI is the future. Step 5, startups raise money at huge valuations because venture capital does not want to miss the next platform shift. Step 6, those startups spend their funding on cloud computing, which becomes revenue for the same big tech companies building the infrastructure. And suddenly, the whole thing starts looking like a circular machine. Money goes from investors to startups, from startups to cloud providers, from cloud providers to chip companies, from chip companies back into market indexes. And then the rising market convinces everyone the story must be working. It is a feedback loop. And feedback loops are beautiful, right up until someone asks where the actual profit is. Because at some point, this entire chain needs one thing: customers who are willing to pay enough money for AI products to justify the cost of building the AI universe. That is the part nobody can meme their way around. A company can love AI in theory and still not know how to turn it into profit. A law firm might use it to summarize documents. A marketing team might use it to write ads. A programmer might use it to move faster. But saving time is not the same as generating new revenue. And generating new revenue is not the same as generating enough profit to justify hundreds of billions in infrastructure spending. This is where the bubble could be hiding. Not in the technology, in the timeline. The market may be right that AI will be huge, but it may be wrong about how quickly the money shows up. And that is how bubbles usually work. They do not always come from stupid ideas. They often come from brilliant ideas pushed too far, too fast, by people who are terrified of being late. Look at the dot-com bubble. The internet was not fake. The people saying the internet would change commerce, media, communication, advertising, and business were mostly right. They were just early, reckless, and financially allergic to valuation discipline. By 2000, companies with no profits, tiny revenues, and business plans that looked like they were written during a Red Bull overdose were getting funded because they had a website. Then the NASDAQ fell almost 80% from its peak to its bottom. Some companies disappeared. Some survived but lost most of their value. And yet, 20 years later, the internet really did become the backbone of the economy. That is the lesson. The technology can win while investors lose. That sentence should be printed on every AI stock chart because the same risk exists now. AI could absolutely transform the economy over the next decade. It could change software, healthcare, logistics, advertising, education, manufacturing, finance, and customer service. But if investors pay a price today that assumes all of that value arrives immediately, then even a great future may not be enough. That is how a real technology becomes a bad investment. Now meet the modern AI buyer. Let's call him Brian. Brian works at a normal company, not a tech giant, not a hedge fund, just a company that sells something boring, like insurance software, warehouse supplies, or the kind of office furniture that looks like it was designed to make employees emotionally neutral. Brian's CEO walks into a meeting and says, "We need an AI strategy." Nobody knows what that means. So Brian's team buys 3 AI tools, signs a cloud contract, hires a consultant, launches an internal chatbot, and puts the phrase AI-powered workflow transformation into a PowerPoint deck. Everyone claps. 6 months later, the company has saved some time, confused half the staff, annoyed the legal department, and still cannot clearly explain whether profits improved. But the vendor counts that as AI adoption. The cloud provider counts it as revenue. The consultant counts it as thought leadership. And Wall Street counts it as proof that the revolution is happening. This is the gap. The market sees adoption. But investors need monetization. Those are not the same thing. Adoption is people trying the tool. Monetization is people paying enough for the tool that the entire economics makes sense. And right now, a lot of AI is still stuck between those two worlds. People use it. People like it. People experiment with it. But the question is whether enough businesses will pay enough money every month for enough AI services at high enough margins to support the massive investment being made today. That is the trillion-dollar question. And it is not just a technology question. It is a depreciation question. It is a power grid question. It is a margin question. It is a financing question, because GPUs do not sit there forever like magical money printers. They age, they get replaced. Newer chips arrive. Training models cost money. Running models costs money. Cooling servers costs money. Engineers cost money. Electricity costs money. And unlike hype, electricity bills do not care about your vision board. This is why the AI bubble may be larger than people think, because it is not only inside AI stocks, it has spread into everything around AI. It is in semiconductor equipment. It is in cloud infrastructure. It is in private AI startups. It is in data centers. It is in power demand stories. It is in software companies adding AI features to defend their valuation. It is in CEOs mentioning AI on earnings calls because apparently saying machine learning is cheaper than actually growing revenue. And this creates a dangerous situation. If AI demand keeps rising, the machine keeps working. But if spending slows even a little, the pain can travel through the chain very quickly. A cloud company cuts capex, a chip order gets delayed, a data center project becomes less attractive, a startup burns through cash, a software company realizes customers do not want to pay extra for the AI button. Investors lower the multiple. Suddenly, the same feedback loop that pushed everything up starts working in reverse. And that is the part markets always forget. Upside stories are very creative. Downside math is very boring, but boring math usually wins eventually. So, what should a normal viewer take from this? First, do not confuse real technology with guaranteed returns. AI can be important and still overpriced. Second, watch CapEx. If the spending keeps rising faster than the revenue opportunity, that is not a business model. That is a race against time. Third, watch margins. If AI products are expensive to run, then revenue growth alone is not enough. The question is how much profit remains after compute costs. Fourth, watch customer behavior. Are businesses paying because AI is essential, or are they experimenting because everyone else is scared of looking behind? Fifth, watch concentration. If a few AI linked companies are carrying a huge share of the market, then your diversified portfolio might be less diversified than it looks. And finally, watch the language. When companies stop talking about actual returns and start talking only about vision, transformation, and long term opportunity, that is usually the part of the movie where the spreadsheet has quietly left the room. Now, none of this means AI is going to crash tomorrow. Bubbles can get much bigger than reasonable people expect. In fact, that is what makes them bubbles. If they popped the moment they looked expensive, everyone would be a genius, and finance YouTube would be replaced by cooking channels. Markets can stay excited for years. Capital spending can continue. Earnings can surprise. AI products can improve. And maybe the productivity gains really do arrive fast enough to justify the investment. That is possible. But the uncomfortable truth is this: the AI bubble is not measured by how fake the technology is. It is measured by how much future profit has already been assumed. And right now, the market is not just assuming AI will work. It is assuming AI will work quickly, profitably, and at enormous scale before the cost of building it becomes a problem. That is a much bigger bet. So, how big is the AI bubble? Big enough that it is no longer just about chatbots, big enough that it touches chips, energy, cloud computing, venture capital, software valuations, index funds, and the entire story investors are telling themselves about the next decade. Big enough that if AI delivers, it could become one of the most important investment themes of our lifetime. But also big enough that if the returns arrive slower than expected, the market could discover that it did not buy the future. It bought the future too early. And that is where I want to hear from you. Do you think AI is A, a real revolution that still has years to run, B, a classic bubble hiding inside real technology, or C, something in the middle, where AI changes the world, but investors still get hurt? Drop your answer in the comments, because AI may be the future, but the future still has a price. Thank you so much for watching. Please comment, like, and subscribe if you like our video. Hope to see you again.